Welcome to Iron Financial, the show where we forge stronger portfolios by cutting right through the market weakness. Today, we are putting on our hard hats and examining the structural integrity of a consumer goods giant, Kimberly-Clark. Now, you might think you know them, but they're not just selling you tissues and diapers anymore. No, they're in the middle of a massive, and I mean massive, corporate reconstruction project. And let's be clear, this isn't just a simple renovation. They are tearing this entire building down to the studs with a plan to build a genuine skyscraper in its place. And that's the multi-billion-dollar question, isn't it? Management is out there showing everyone the glossy architectural renderings for this gleaming new tower, the Kenvue acquisition. But our job here at Iron Financial is to do the dirty work. We're going to get down in the mud, and we're going to stress test the very foundation of this company. Is this thing built on solid, reinforced concrete, ready to support a massive $32 billion expansion? Or are we about to find some serious structural cracks that could bring the whole thing crashing down? So let's get into the numbers, because as we always say, the numbers never, ever lie.
All right, let's get right to it. You know, every good structural analysis has to start with the raw data, the survey of the land. And for us, that means we're looking at Kimberly-Clark's Q4 2025 income statement. This is the bedrock. This is our ground truth. We have to inspect every single inch of this foundation before we can even begin to talk about building a skyscraper on top of it. So let's see what the initial survey tells us.
And right away, we find a hairline crack. Look at that number. Net sales are down 0.6%. Now, okay, that doesn't sound like a catastrophic earthquake, I get it, but in the world of consumer goods, a negative sales number is a tremor that you absolutely cannot ignore. This is a volume game, pure and simple. You can't build a bigger, grander building if you have fewer people walking through the front door. Sales are the lifeblood. They're the cash flow that pays for all the steel, all the glass, all the labor. So any negative top-line number, no matter how small it seems, is a bright red flag warning us of potential foundational weakness.
Whoa, hold on a second. That's a surface-level view. You're looking at the paint job on the outside of the building. I'm looking at the core engineering deep inside. Look here. Operating profit is up over 20%. Let me say that again, 20.7%. That isn't a sign of weakness. That is a sign of extreme, almost ruthless discipline. It's the mark of a master builder at work. See, they aren't just trying to get more people in the door at any cost. They're making the entire operation more efficient, more profitable by trimming away every ounce of dead weight and reinforcing the core structure from the inside out. This is exactly what a smart company does to prepare a foundation for the heavy lifting of a massive acquisition.
Now let's really dig in here, because what's so interesting about this slide is the detail. This is where you see the blueprint really in action. Don't just look at the top line and the bottom line. That's the amateur move. Look inside. Look at cost of products sold. That's the direct cost to actually make their goods. It's down 1.7%. That's impressive efficiency right there. But here's the real kicker. Marketing, research, and general expenses. That line is down a whopping 5.1%. They spent over $50 million less on things like overhead and marketing, and yet their sales were basically flat. This shows they are systematically and ruthlessly reinforcing their margins, building a leaner, meaner, more efficient machine. That is what a solid foundation looks like. It's not about size, it's about density and strength.
Efficient? Or are they just shrinking? That's the real question, isn't it? You're calling it discipline, I'm calling it corporate anorexia. I mean, you can only cut so much fat before you hit bone, and then you start cutting into muscle. So the crucial point for me is this impressive profitability is coming from cuts, not from organic growth. It's a contraction story, not an expansion story, and that is not a long-term blueprint for success. That's a short-term fix to make the numbers look pretty right before you go ask for a huge loan to buy another company. You cannot cut your way to becoming a global health and wellness leader. Sooner or later, you have to actually sell more stuff to more people.
Okay, to answer that very important sustainability question, we have to look at the official schematics. Management has a whole plan they've been talking about, called their Powering Care strategy. We like to call it their structural reinforcement program. This is the engineering philosophy behind every single cut and every investment. So let's get in there and deconstruct this engine to see how it's really supposed to work.
And here it is. This is the engineering diagram for the entire operation. The CEO, Mike Su, he calls this the virtuous cycle, and it's designed to be a self-powering engine, a feedback loop. The idea is actually pretty simple, but it can be really powerful. You start by investing in your big, iconic brands to make them stand out. That differentiation is then supposed to drive higher sales volume. Now, as that volume grows, you find new efficiencies in your supply chain and you reduce costs. That cost reduction, in turn, delivers better financial performance, which, well, it gives you more capital to pour right back into your brands at the beginning. It's designed to be a self-reinforcing structure, gaining strength and momentum with every single rotation.
You know, it looks great on paper, but let's be honest with each other. Every C-suite in America has a PowerPoint slide that looks exactly like this one. It's corporate bingo. But a virtuous cycle can very, very quickly become a vicious cycle if just one of these steps fails. And the weak link in this chain? Well, it's staring us right in the face. Step 2, grow volume. As we saw just a few slides ago, their net sales are negative. Their volume isn't growing. So if the second step of your big 4-step plan is already broken, how virtuous can this cycle really be? To me, it looks a lot more like an engine that's turning over and sputtering, but it's just failing to catch.
But this is what brilliantly illustrates their commitment to making that engine work. This isn't just talk and a bunch of fancy charts in a presentation. They are taking decisive action. Look at this timeline of divestitures, which is just a fancy term for selling off parts of the business. They are surgically removing the pieces that just don't fit their high-performance model. In mid-2023, they sold off their Brazilian tissue operations. A year later, the PPE business was gone. Between 2022 and 2025, they walked away from roughly $650 million of lower-margin private label business. And they're not even done yet. They are systematically cutting away the non-essential parts of the business to focus all their resources on their right-to-win spaces. They are improving the load-bearing capacity of the entire company by shedding all that dead weight.
Okay, fine. Let's grant that. Let's say they've spent the last 2 years reinforcing the foundation, patching up the cracks, getting rid of all the clutter in the basement. So now, after all that hard work, they want to build a $32 billion skyscraper on top of it. This is where the real risk, the real structural stress, comes into the equation. All that foundational work means absolutely nothing if the skyscraper you build on top of it is too heavy or poorly designed. So let's pull out the blueprints for this massive Kenvue deal and see what we're really looking at.
Now, from management's perspective, this is the ultimate payoff for all that painstaking foundational work they've been doing. The CEO, Mike Hsu, he doesn't see this as just adding another floor to the building. He says it will literally catapult their trajectory. They're not just buying a company, they believe they're buying a new, faster, more profitable growth curve. They're convinced that the powering care engine and that virtuous cycle they've been fine-tuning can be a plug-and-play model to supercharge Kenvue's portfolio of already market-leading brands. This is their generational bet, plain and simple.
And here it is. This is the steel frame holding this entire deal together, $2.1 billion in projected annual synergies. Now, synergies are just the savings and extra profit they expect to generate by combining these two massive companies. Let's be crystal clear about this. The bulk of that, a staggering $1.9 billion, is from cost savings they're targeting within the first 3 years after the deal closes. That's the heavy lifting. That's the cold, hard cash that makes this whole ambitious project look profitable on paper. It's the financial engineering that justifies the absolutely massive price tag.
That is an incredibly aggressive construction schedule. I mean, let's just put that in perspective for a second. They are planning to extract 80% of those cost savings. We're talking over $1.5 billion within 24 months of closing the deal. And this is from merging two massive, complex global companies. That is a monumental, almost heroic task. Any delay, any unforeseen problem with integration, any culture clash between the two businesses, and the financial structure of this entire deal gets very shaky very fast. They are promising to build a skyscraper in record time, and as any builder will tell you, that's where big mistakes get made and budgets get completely blown.
But you have to step back and appreciate the sheer scale of the ambition here. This transaction fundamentally changes what Kimberly-Clark is. Just look at this chart. They go from being a personal care company to a global health and wellness leader. They go from having a handful of iconic brands to controlling 10 iconic billion-dollar brands. Their focus expands from general personal care to really high-value, high-margin categories like baby care, women's health, and the fast-growing active aging market. This isn't a renovation. It's a complete tear-down and reinvention into a consumer health powerhouse. They're not just adding a new wing. They're building an entirely new fortress from the ground up.
You know, ambition is one thing, but execution is a whole different ballgame. Anyone can draw up a beautiful blueprint. The real test is in the build-out. And so, the 2026 outlook is our first real glimpse into whether they can manage the current construction site while simultaneously planning for the next massive one. So what does the foreman's report say for the year ahead? Can they actually keep the lights on while they're trying to rewire the entire building?
The plan they've laid out is robust and it's clear. For 2026, they're guiding for organic sales growth to be at least in line with the market, which directly addresses your earlier point about the top line. They're projecting mid to high single-digit growth in adjusted operating profit, and even more impressive, double-digit growth in adjusted EPS. That's earnings per share with some one-time costs stripped out to show you the core business health.
And crucially, they expect to maintain that strong cash flow, projecting another $2 billion in adjusted free cash flow for 2026. And get this, they're doing this even while they're increasing their capital investments to $1.3 billion. They're funding the future from their present strength.
Well, the numbers look nice and balanced on the surface, don't they? But the fine print always matters. Look at that adjusted EPS split. 53% in the first half of the year, only 47% in the second. So why the front loading? Well, because as they state in their own documents, they're expecting dilution from their international family care JV transaction, that's a joint venture or a business partnership, in the second half of the year. It just goes to show you how incredibly complex this whole operation has become. They aren't just managing one massive construction project with Kenvue, they're juggling multiple transformations all at the same time. And if one of those balls gets dropped, it could cause a whole cascade of problems.
So here we are. We've stress-tested the foundation, and frankly, we found a mix of concerning cracks and some really solid reinforcements. We have reviewed the blueprints for their powering care engine and for the incredibly ambitious Kenvue skyscraper. We've looked at the foreman's report for the year ahead. Now it is time for the verdict. After inspecting this entire project, from the bedrock to the penthouse, is Kimberly-Clark an opportunity to get in on the ground floor of a new empire, or is it a trap just waiting to collapse?
The bull case is clear. You could argue this is a masterclass in corporate engineering. Management has spent years building a financial fortress with a highly profitable, highly disciplined core. Their powering care strategy isn't just a slogan on a PowerPoint. It's a proven, repeatable engine for creating efficiency. And now they're leveraging that immense strength to execute a transformational acquisition that gives them massive scale and absolutely huge synergy potential. The bulls believe they are building this company for durability and for long-term market dominance. But the bear case is that it's all just a beautiful facade hiding a weak foundation. You have an enormous, risky, debt-fueled expansion plan that is being built on top of a core business that isn't actually growing its sales. The so-called virtuous cycle is a complete fantasy if you can't get that flywheel of volume growth spinning. The Kenvue integration carries enormous execution risk, and a complexity of juggling all these moving parts at once could lead to critical, catastrophic failures. If anything goes wrong with this build, the whole structure is at risk.
So the crucial point for every investor boils down to this. The blueprint is ambitious, no doubt. The potential reward is massive, and the numbers they're projecting are certainly compelling. But it all comes down to one simple thing: execution. They have drawn up the plans for an empire, but is it a solid investment that will stand the test of time, or is it a house of cards just waiting for a gust of wind? That's the question you have to answer before you put your hard-earned capital to work. Thanks for joining us at Iron Financial.